Hey everybody, so we got Eric here. As always, we got a super awesome Money Talks set up for today. So I have David here. He's been in the markets for a hot minute at this point. What is it, over 40 years now?
Yeah, it's 48 years.
So coming up on 50. That's a
Yeah,
big
I'm one of the old geezers out there.
Yeah, that's a big milestone. But so we were just talking a little bit about your background and whatnot. But first, I'd love to just welcome you to the channel. Thank you so much for taking some time to chat with me and in the audience. We really relish specifically these kind of opportunities because folks like you with your kind of experience, like I was saying, I think it's monumental for other people to try to pull as much of that as we can because like I said, I started trading in 2007 and I know what I know, which is a snapshot. Really, it's a fraction of what you've seen. So I'm really looking forward to just discussing a little bit about, what you've seen over your years and get some ideas on what you're thinking looking forward. So first, like I said, welcome to the channel. And I would love to just start with a little bit about your background, where you started in just your macro level view of things and your relationship with the markets.
Sure. Thanks, Eric. Thanks for having me on. Yeah, I not to get too caught up in the the beginnings of this, but I did start as a finance major in college back in I entered college in '69, so that was Vietnam years, and as I joke, hardly anybody was a business major back then. People were trying to avoid the draft, and most of them were what we called hearts and flowers back then, but liberal arts and things, just taking something to stay in college. But I knew, for whatever reason, I knew from early on that I was interested in finance and did undergrad finance and MBA with a finance background while I was working in a bank. I started right out of college in a small bank investment department. So I really attribute a lot of my success to that, really, because I was part of basically a two-man investment operation where I got to manage bank portfolio as well as trust portfolio. So then I got exposure to bonds and stocks. If you go to a bigger place, you usually have to specialize in one or the other. So there was a lot there that gave me kind of access to macro. And I went to another bank, bigger bank, where I had to choose, and I went to the trust department because I wanted to do stocks. And in about 4 years, got recruited away or applied for a job as a equity pension fund manager for a Fortune 100 company. And that kind of really jump-started the career where I was a sole equity manager within an in-house, within the corporation. They managed their pension assets in-house. So they had two people doing private placement. They had, a couple people doing bonds, and they had me doing equities. And it really gave me, again, the ability to kind of be on my own, not be part of a big team or anything. So as I said, I was chief cook and bottle washer, where I had to, trade. I had to manage portfolio. I got to do the strategy and all of that. And I think I was 30 years old when I went in there. And it was Textron. Their former CEO had been G. William Miller, who went on to be Carter's Fed chairman. So he was chairman during the late '70s when inflation took off. He had left by the time I got there, and was Fed chairman. But his legend, he was a very well thought of CEO, and really was, Textron being a conglomerate, they were kind of their in-house stuff was very much private placement oriented, because that's what a conglomerate does, is buy assets. So I heard all through, when I was recruited, they had very little equity, and then they missed the 1980 oil market, so they dropped from a top quartile investor down to mid quartile. And so they brought me in. I was counseled by all kinds of people on the street saying it's a dead end, they don't like equities, don't go in there. But I saw it as a chance to kind of show what I could do. And they I was, had to report to an investment committee, which was the chairman, president, and a bunch of their group officers who ran the conglomerate, the divisions. They were all in their late 50s, early 60s. And here's this 30-year-old kid saying, yeah, I know what G. William Miller said about the risks, but I can show you how to do this conservatively and perform. I look back now and wonder how they ever believed that. But I'd have to go to meetings and kind of piece by piece sell them, because they had 10% of their assets in equities, and most of those equities when I came in were almost private placement, small, not heavily traded stocks. And in the 5 years I was there, I had top percentile performance the whole 5 years. I took them from 10% of their assets equities to 50% because of the performance. And it just, from there I went to Fidelity, and then went to ITT Hartford and ran their active equity effort. Was a CIO of a $1 billion firm in New York. And then the second half of my career was as a macro strategist, which I still do today. So that's kind of a thumbnail sketch of my background anyway.
Which, as a thumbnail, it's still far more than any experience I can drum up. So I actually wrote a bunch of questions down just from that I'd love to just tie into a couple of them. So one of the first things you mentioned was, like your post-college small bank experience. And to me, it seems like there's a lot of value. It almost seems like a startup experience where, you're brought in and you end up doing a lot of things at once.
Mhm.
While you were doing different things that, like you said, you're trading, looking over, some of the different allocations, things like that. What was your interest at that point when you were at the small bank, and why? Like, what did you like working on the most?
Yeah, well, it was all investment. It was this was in Indiana, and Indiana at the time had branching couldn't go beyond county. So this was before your time. We never had nationwide banks. We had statewide banks, and in some states like Indiana, it was countywide, and you couldn't go outside your county. So we had several branches in the county. We were the largest bank in the county. So in a lot of ways, you accumulated talent in these small banks that you wouldn't today.
Mm,
Today's branches of the big banks, you basically have people that are following formulas. If you're going to make a loan, you're going to follow formulas, whatever. So I felt very fortunate. This was a fairly progressive bank that had some pretty good talent that came out of bigger city banks to go out away from the cities and run something themselves. My boss was, I think, 30 at the time, so he was relatively young, but he'd come out of an Indianapolis bank, and he was pretty progressive. In fact, he helped write some law in Indiana where county treasurers and town treasurers could do repurchase agreements with the bank and earn higher returns than they could get through normal investments in bonds or whatever. And so he kind of created that and for the state.
hmm
And so I was learning at his side. Um, and then he'd have me work on portfolios, etc. The other thing I got, as I said, I was doing trust, which is customer portfolios, but also bank portfolio, which is mostly bonds,
hmm
mostly government bonds. And I was also sitting on an asset liability committee, which was made up of my boss, the head of the bank, the comptroller of the bank, and maybe one other person. But so I was able to kind of understand things that people in bigger banks would never see until they were 10 or 15 years into the business.
Right.
Um, and so when I went to a large bank, it was pretty interesting because I chose to go the trust side, but I'd still talk to the bank people, and they were surprised at the knowledge I had 5 years into the business. And it just, I think sometimes being a generalist early on can be really, really educational.
Mm. That makes a lot of sense. To be honest, actually reminds me when I went on active duty in the Marine Corps. They do a very similar thing where a lot of jobs, a lot of your initial jobs, they can rotate you all different kinds of places. And it's for a very similar reason because you get to learn
Mhm.
how the organization works as a whole. You get some, specific experience with where you are, and then as you rotate out. So that, yeah, when you were mentioning that small bank experience early on, it's just funny to me because it seems like that sends you on a very different trajectory than if you went to a big bank, you got really good at one specific thing.
Yep.
So then you talked about going to kind of getting into like pension management. Um, I'm just curious what drew you in that direction as compared to, whatever other moves were available. I assume they were numerous in nature. What sent you that way?
What it gave me the opportunity, being in a bank, you're part of a team. There were probably 10 portfolio managers within the bank that I was working at the time. And this gave me the opportunity to kind of be my own little fiefdom, my own little show.
Got it.
And most importantly, gave me the ability to develop a track record, because pension funds, you're tracked performance wise. And I had enough confidence in myself that by then I've been in the business, even though I was only 29 years old. I've been in the business 8 years, and I was pretty comfortable as a value manager. That's kind of how I gravitated, that I could manage money conservatively and perform well. And, was a pretty good stock picker, et cetera. So it was that, and, I was still in a bank that wasn't necessarily giving me a fast track. So it gave me the opportunity to get to somewhere where I felt I could, fast track more. And it really worked out in spades just because I hit the ground running. I think I went in late 81, and I told them to keep their powder dry. We were in the midst of a bear market.
Right.
Um, and then in August of 82, which in hindsight was the absolute bottom of the market, I said it's time. I had built up a list of stocks that I felt would be, buy candidates when we were ready to buy. So in August, I went to a committee, the investment committee, with the other investment people, and I asked for, I don't remember how much money, but again, the portfolio was 50 million at the time, and I may have asked for another 50, and they gave me 25, or we may have asked for more, and they gave me half of that. But I came out of that meeting, again, I was 30 years old and, hot to trot. And it was, um, I came out and I can remember being upset that they cut it in half. And I said, the
Mm.
market's getting ready to go here. We've got to get, my boss is going, you don't know how successful that was. He goes, you're talking to a group of guys that have been taught through the former chairman never to go this direction, and you talked them into it. So he said, we really made a major step today. So it was that kind of thing for the next several years where I'd ask for something, they'd cut it in half. But my boss would keep saying, we're moving in the right direction. We're really, and like I said, in 5 years, we went from 10% of assets being equities to half of the portfolio being equities. And we went from a $500 million pension fund to a $1 billion pension fund. So I ended up going from 50 to 500 million in equities. And I was it. I mean, I shared a secretary with a couple of the other asset guys doing, real estate and bonds. And other than that, it was me, so it was fun. You got to really do the whole shebang.
That's pretty awesome. So, yeah, one of the things you mentioned that I was curious about was like when you landed there, you kind of were focused on equities. What sent you that direction as compared to something like bonds or real estate?
Just was interesting.
Got it.
I don't know. Just kind of, I think a lot of people see equities as more fun.
Yeah, yeah. It's one of the reasons why I asked that question is because I think there's like quite a few bankers that follow my channel a little bit now, and I know a lot of them have a very mixed relationship when they have any sort of interaction with bonds, especially today. It's a very, very different world, I think, compared to what bonds were doing, 70s and 80s. So it seemed like equities was a lot riskier for you, but that seemed to drive you a little bit. Is that probably fair?
Equities in general tend to have higher risk attached to them. I don't know that I gave it that much thought. It was really just, I had learned both bond side and equity side and kind of said, this is the side I like better. So, um, there's probably more variety of what you have to do within that. I mean, but
Right.
bond guys have a lot on their plate too. So, um, you know, I'm certainly very happy I went in the direction I did.
Right. And then just another, this one's kind of a personal question for me because it's something I probably will never experience though. What was your relationship and what were the interactions with the investment committee like? So you gave a little overview of just a little bit of, how they were kind of used to and set in their ways in terms of how they normally conduct business. You were able to persuade them a little bit to take a little different direction. I'm just curious in general, what were those interactions like with the committee? Were they agreeable while you were discussing with them? Were they eager? Were they kind of shut off but then agreed? It just seems like a very interesting dialogue to have with somebody, when you're coming with a pretty big ask that is counter to their, typical way of doing business.
Yeah, and I should preface that by saying that the money was pulled in house back in the mid '70s after the '74 bear market, which was the worst bear market we had had since the '29 crash. So '74 into '75 was pretty awful, and G. William Miller was chairman at the time, and he pulled all the money at that time. Most pension money was managed by the big New York banks, Chase Manhattan and J.P. Morgan and Citicorp, et cetera. And it was all concentrated in New York, and it got into the Nifty 50. The market that peaked in '73 was known as the Nifty 50 because it was pretty much 50 big stocks, IBM, General Motors, et cetera, at the time, and they became known as one decision stocks,
Mm.
which all the portfolio managers in New York that worked for these banks would all go to the same luncheons and buy the same stocks, and so it became a very narrowly focused market of 50 stocks. And then when the recession came, when the bear market came, they crashed. I mean, they went down big, and so pension funds really lost a lot of their value.
Right.
G. William Miller pulled his money, Textron's money, out of the banks, brought it in house, and said, "We're not doing that again." That's why they were taught, equities are a bad thing.
Right.
And he said, "Never again do I want to approach some of my executives that are very close to retirement and tell them that they lost half their pension assets, at retirement time." So that's why and from that point forward, from the mid '70s till I came in, the idea was we'll get returns through private placements and through bonds and things that are more stable. And they did very well. They were top quartile doing that because, Textron was kind of that way with their private, their company purchases and things. So they were just kind of following the culture that they were used to. So I was a step out of that. I was coming in and being very opposite to that culture. And so I can remember, and again, you think you're 8 years in that you got all the knowledge, and I look back and go, holy cow. I didn't know diddly squat at that time. I had a pretty good idea of how to make money, but I can remember one of the group vice presidents in particular was kind of an old codger. He was pretty, he was very skeptical. Let's put it that way. And I think for the whole 5 years I was there, I knew at every meeting that when I presented, I was going to get from him a lot of skepticism about what I was proposing. So, it helped me because I knew I had to kind of be sharp with my answers, know my stuff when I went in. And
Right.
I really credit my boss was well respected, and he made sure we knew what we were doing when we went in. We didn't go in unprepared. So, but it was, again, it was a fun experience, but it was also I knew that, I was kind of pulling them kicking and screaming to where we were going.
That makes a lot of sense. I actually think it's also really cool though that you mentioned your boss and how he was supportive of you, because I feel like, that's just a really important part of being able to sway
Sure.
old institutions like that. The reason why I'm really curious about the conversation obviously is just that event in and of itself is interesting to me, but I do feel like there are some tenets of that we see now when we're talking about cryptocurrencies coming online, and a lot of, places are super resistant, to the idea of that kind of, technology and whatnot. Um, and it's just fascinating to me how like some of those kind of tendencies can just repeat over time. Obviously, different overall scenarios, but nonetheless, I just draw a parallel between those two when I think about them. Um, the other question I had just on your experience while you were still there was, you said that you took them to about 50% in equities. Do you know, out of curiosity, like when you left to your next gig, did they maintain that kind of allocation? Did they, as an institution, change their approach, or did they go back to being a little more conservative?
Yeah, I wouldn't talk out of school, except it was so long ago, so I think I can. Um, Interestingly, um, part of my success there, like I said, if you looked at the style boxes or you looked at the performance boxes, you have the four quartiles, and it was the SEI pension fund, equity pension fund universe. So I was compared against pretty much the pension fund universe in the country. And if you looked at the boxes, I was outside the top quartile. I was outside the top percentile. I was, way up here, and so part of the way I did that, and it wasn't necessarily the strategy was deliberate, but I wasn't doing it for performance reasons. Other than that was what I thought we should do. Um, the In the early '80s, inflation peaked, oil peaked, and I I think this is where so much, all the way out to now, 48 years later, I see the same mistakes being made by money managers. Is they tend to manage looking backwards. So
Mm.
they're extrapolating what's going on. And what I said was, this was 1982. So we were in the midst of a recession, but we had just come through oil going from, um, you know, wherever it came from to, 100 plus dollars. And oil was the darling on the street. So all the portfolios across Wall Street were loaded with oil. 35% of the S&P was energy, and particularly oil. And I had zero weighting in oil. I basically said, if you're looking backwards, yes, that's where you want to be. If you're looking forward, we're basically at the peak point in inflation. Keep in mind, inflation at that point was 20%, or what had been in 1981. So I said, you know, where most managers were saying we need inflation hedge stocks, I said, we're at the maximum point for inflation. Everything going forward, the rate of change, the forward-looking change is going to be away from inflation, even though you're going to go maybe from 20 to 18 and then 18 to 16, so you're still going to have high inflation. You're moving on a rate of change basis away from inflation. And I said, basically, the Fed will, is committed to taking inflation down, ratcheting inflation down over time, not over a few years, but over a cycle or two or three. And so I said, what you want to own, if this is the peak of inflation, is you want to own those things that got beat up by inflation. So that means growth stocks. That means, particularly the consumer growth stocks. So I was buying Coca-Cola at book value. I was buying Warner Lambert, which was a big drug company, at book value. I was buying Merck at book value. I was buying, I'm trying to think of some of the other names I had, but they were basically, Carnation was one, just a food company. They were things that were really flat on their butts because inflation had really damaged them. But I was looking at what was going to happen going forward. And that two things really helped my portfolio. One was I didn't have the things that became laggards, the things that were dragging down other portfolios, meaning energy, that had peaked and was now over a long period of time going to be distributed.
Right.
And I had the things that were beginning to be accumulated. So what happened from 1982 to 1991 is you had some of those growth stocks go through the roof. You know, you had a big, long growth stock, consumer growth stock cycle where all the brand name companies did exceptionally well. And when I bought them, they were hated. Nobody wanted them. So, you know, very early on, and I had been before I got to Textron, I've been contrarian. You know, it just comes naturally to me to want to be where other people aren't, and to want to, as Wayne Gretzky used to say, you know, what makes me great, or when people ask why he was so good, he said, I skate to where the puck's going, not where the puck is. You know,
Mm.
and it's kind of like that. You want to look ahead, not focus on backward, or as I call it, rear view mirror investing, or sometimes I call it extrapolation fever. People extrapolate current trends to the future. And a lot of times, if you're at a turning point, that's the worst thing you can do.
That it's yeah. I mean, it makes so much sense, and it feels like traders. We hear that from so many different places, and folks that follow the markets, and then there it is. Everybody's there with like their technical analysis, which is all historic in nature. It's
Yeah,
just it's
historic. It's historic, and it's typically momentum driven.
yep.
So if you're at an inflection point, that's the last thing you want to do is go with the momentum, because it's going to
Right,
reverse.
right. Yeah, that's I don't know. I look at that and it's those are the kinds of things that in hindsight, it's like, yeah, that's the obvious move. But I feel like what people don't capture when people like you say those things is just the amount of conviction you had to have to actually be a contrarian, to actually do something that everybody else was kind of nervous to do. Um, Again, just from like a personal perspective, I would be really curious to just dive into that a little bit more to understand, the concept behind looking forward, projecting, in terms of your best assessments where the market is going, not where it's been. But how do you reconcile with yourself in making those decisions when you look left and look right and the trend, everybody else is stocking up on oil and you're like, well, I don't know about oil. It doesn't seem like it's going to be the next big thing. Do you think that your conviction was just, well, I think this is going to happen, so I'm going to go with it? Or like, how did you get comfortable being that person that is the contrarian in that scenario?
Yeah, in that particular case, it was, I had certainly my MBA was in Chicago, so I had a monetarist kind of background coming in, and what the Fed was doing. I really from early on was a Fed watcher and somebody who really was fascinated by macro. So I felt my macro by the time I was 8 or 10 years into the business. I had a pretty strong macro background, so I had that part of it, where I looked at the Fed and said they're very committed to inflation, winding out inflation, not quickly, but over time. Um, so that was the macro side of it that said, yeah, if you're going to see inflation peak here and ratchet down over time, you want to what benefits from that? So that's the one side of the coin. The other side of the coin is really the investor psychology side of the coin, which is understanding how much psychology plays a role in investing and how much it plays a role in prices. And being, and I always say, I think I'm a natural contrarian in that I would say probably 90% of people are not comfortable um, marching to their own drummer. They're not comfortable being outside the crowd. They may say they are, but when push comes to shove, they're not comfortable if they're way apart from the crowd. I've never had that problem. It doesn't bother me if ever. In fact, certainly through 48 years now of doing this, the times when I know I'm right or when I'm going to have most success is when people are calling me a fool and saying, because psychology has taken over the narrative and crowd psychology. And so it's when nobody agrees with me that I usually have my best success.
That I literally love that. It's something that I talk a bit about on, at least with my audience, is just investor slash trader psychology, and kind of really understanding ourselves, but then also understanding that a lot of the models that we use, even in derivatives with the Black-Scholes model pricing, a lot of things are built around people that execute in a very specific logical way. And a big disjointed function of that is the fact that the markets really aren't rational all the time. There are plenty of instances where there is like human psychology that's integrated in one way or another. And it like I feel like that effect can't really be overstated, because a lot of folks still look at their models and stuff and say, well, why is this happening? This isn't right. And then they fail to remember that the markets, even institutions and stuff, they're still people, and there's still an inject of the human psyche in what's going on. That really resonates, that part of the message.
The other thing that I think most people don't understand, most investors don't understand, and a lot of even professionals I think forget, is the stock market or any market is a discounting mechanism.
Mm,
So it's discounting things way ahead of the time that it occurs. The stock market in particular will be discounting things sometimes 6 months out. And yet the way people think, and it's helped along by the CNBCs of the world, is they think that market movement is based on today's news. So
right.
because every day they get they get a summation of what happened today, and they always tell you the reason why it happened. Except in the scheme of things, in the longer scheme of things, what's going on in the market today may be discounting what's going to happen, 3 to 6 months out.
Right.
Because there are lots of factors you can look at, what we call second derivative items, rate of change, things like that, that investors look at or analysts look at. So it's very hard for retail investors to understand why markets don't don't move the way logically they expect them to. So like today or this week, um, I had somebody ask me on Twitter just today, can you explain to me why, um, you know, Powell's telling us he's going to accelerate taper and do double the taper, and the tightening is going to come sooner. Why did interest rates go down on that? They can't quite fathom. I thought if he's tightening, rates are going up. And I said, no, it's a couple things, but it's the street looking at the fact that if he's tightening, he may actually slow the economy, and that's going to help bonds, and he's going to slow inflation. And secondly, his actions are hitting the stock market. His comments, and so it's basically it's they're buying bonds as a safety. They're looking at
Right.
a risk off moment. So it's a lot of times you have to kind of look further than what's obvious. Um, but going back to psychology, I get a lot of questions about, because I've been around so long, what books taught you to do what you do, and how did you get here? Can I have those books? Can you give me a list of books? And I go, I only recommend basically one book. I said I read it in 1977. I was already a contrarian at that time, but it really resonated with me and that it spoke my language. It was a book called, at that time, it was called The Psychology of the Stock Market by David Dreaman. David Dreaman had been a Forbes columnist, a syndicated Forbes columnist, but he has written many, it's been revised many times. I think the last revision is maybe 1998, and it's called Contrarian Investment Strategies now. So it's a different title, but I've only read the original, but I think it's pretty much the same book. And I recommend that to any investor, particularly any retail investor. He does a very good job of explaining how much psychology plays a role in investing and in stock market. And I think that is the most important lesson that investors need to learn, because they really can't, they don't understand the psychology and how that impacts.
It's funny you mentioned that book because that's actually one that my mentor spoke about a little bit, and it's the original version. I actually didn't know that it was revised into the contrarian investment strategies. I gotta check that one out because he used to share pieces of the older version with me, but I actually be really curious to see how it's evolved over time because I think a lot of I don't know even the nature of being a contrarian I feel like has changed over time with how far you take the concept of being a contrarian. So that's I'm glad you mentioned that book. Thank you, because I definitely will check that one out. Um, so then we're moving along in your career a little bit. You ended up shifting kind of to macro analysis, macro view of the markets. What drew you that direction?
Yeah, it's kind of a personal story, but my daughter became very ill
Hmm.
with Lyme disease and missed high school. Basically, she went from top student in her class in her grade in a good school system in Connecticut, and Olympic development level soccer player, wanted to play Division I soccer, and at the end of eighth grade got diagnosed with Lyme disease. We didn't realize for several months what was going on.
Yeah,
And she ended up missing high school. She missed 5 years of school because and people don't realize, but it's a neurological disease. It gets
my
into the nervous system
my dad had it.
and really can really. She had severe fatigue to the point. Again, this was a highly tuned athlete. She played basketball, softball, and soccer in particular year round. And there were times when I had to carry her up to bed because she didn't have the energy to climb the stairs. So it was a real dramatic change for us. And I just made the choice to stay home
Got it.
and look for answers and get her turned around. And it took a lot longer than I expected, but I had a friend that had covered me on Wall Street, and he said, if you want to be our strategist, come on, come on in. You can work from home and do your work there. So that was really what triggered me going from what's known as the buy side to the sell side in terms of I was a sell side strategist for a firm in New York.
Sorry to hear that. That's yeah.
Yeah, good
That
news is she in 5 years I became. I mean, to this day I'm a Lyme disease advocate, patient advocate, and ran support groups from 2004 until now to help people, and have been very involved in looking for answers and staying up to speed on research and things. Um, but she ended up turning around. She got her GED. She, like I said, she literally missed 5 years of school. Got her
yeah.
GED, scored really high on her SATs in spite of basically an eighth grade education, plus a few other classes. And she ended up graduating with an economics and chemistry degree with a 4.0 from a
It's awesome.
good school. So she was that kind of kid, which she just didn't give up. She didn't let it
Right.
get her down. It took a lot away from her. That was my passion. I wanted to play soccer, and I never got a chance to even play high school. So, she had those kind of things, but she made the best, and she's a mom of three boys now, so she's doing pretty good.
That's awesome. Yeah, sometimes, we might have like a specific projection for life and then life does what
Yep.
life does. Adds a
Yeah.
pretty good curveball. Just out of curiosity, did she get Lyme disease from a tick or was it something else?
Yeah, we lived on 8 acres in Connecticut, and Connecticut's kind of the epicenter.
Yep.
And at the time, um, I didn't know what I know now about Lyme, and unfortunately, the 99% of the public doesn't know because the establishment doesn't put out good information. But if you catch it early and treat it properly, and those are key words because you can treat it improperly even though you catch it early. But if you catch it early and treat it aggressively, you can knock it out and never have a problem. In her
Mm,
case, we didn't really catch it till a year into it, so it had gotten into her nervous system and really wreaked havoc. I mean, we saw a kid who was really the top student in her class for 5 years, was a special ed student for 3 years. She said, I can read this to you, Dad, but I can't tell you what it means anymore.
Right.
I can't follow it. So I will tell you, an awful lot of Alzheimer's, an awful lot of dementia. You see, if you go on Cape Cod or somewhere in a nursing home, you'll see 45-year-old men with dementia. I guarantee it's Lyme disease, undiagnosed. A lot of what we're seeing with long haul COVID is kind of what we saw with Lyme disease.
It's interesting. I just remember, I'm like I said, I'm from New York, and my dad and I, we would go hunting, and one time, like, we always try to check each other over for ticks, especially on your back and stuff. And I remember we plucked one off of him, but then like 2 days later, he had that big old dinner plate red bullseye there, and we're like, uh-oh.
Yep.
And we're Polish in descent, so making fun of ourselves a little bit. He just said, whatever, just completely ignored it, and sure as shit, it started to become a big issue. So that's why I was curious. I just remember in the Northeast, the ticks, when they're brutal.
It's all over the country now, but it's the Northeast is really the epicenter, and New York's loaded. New England's loaded.
Yeah.
But it's down in Texas, it's out in California, it's down south. And I can't tell you, I won't spend time here saying it, but the CDC and the establishment are just so wrongheaded on it, and they put out stuff that it's really, if people knew what this caused, there's an awful lot of what we call autoimmune disease,
right,
and the MSs of the world. An awful lot of that is undiagnosed. I say Lyme disease, but it's really tick-borne disease, because the ticks bring in several different neurological diseases.
Gotcha.
And because the CDC will, and the infectious disease side, refuse to accept that Lyme can be long-lasting as an infection. Even if you treat it, it can evade the treatment. They just say 3 weeks antibiotics. If you still say you have Lyme, then it's in your head. You just imagine it. So you really have chronic Lyme disease is a very serious problem that's not really being addressed properly.
It's interesting. Yeah, it's really interesting. My dad definitely fell in that same category, just where he definitely didn't treat it right, looking back at it.
Yeah, there are specialists. I always say to people, if you have cancer, you go to an oncologist. You don't go to your PCP.
Right.
It's the same thing with this. You can go to what we call Lyme literate doctors, that are the ones in the trenches that know how to treat this long term. And they know the tricks, and they know the proper treatments. If you go to your PCP, they're going to give you standard infectious disease guidelines, and again, if you catch it very early, that might do it. But if you have it in chronic form, it's impossible to treat that way.
Right. Yeah, it needs more robust protocols.
Yep.
Well, it's really good to hear that she got her life in a better spot for herself and move forward. That's honestly, those stories are always really awesome to hear in that sense. We get a lot of it, from the military. There's dudes that go through these horrible scenarios, and some of them just find this magical way to rebound. I always find those people just to be really inspirational. So thank you at least for sharing her story too, because that is inspirational to hear.
Sure.
So something that a few of the folks from my audience are like really curious about is, obviously last year with COVID and all that, super unique scenario that we experienced. And throughout this year, in a lot of ways, it seemed, at least to me, a bit of an anomaly in certain instances. But I'd love to start to just get an understanding of how you view the markets in 2020, looking back at the whole year. Like, what did you see that you were like, that kind of stood out to you?
Yeah, I came into 2020 with a view that we were going to have a melt up, probably first half of 2020, and then a global bust and a big bear market. In February, I said, and if you remember, the market was moving up and up and up, and I kept saying it's going to come down, and people started picking on me because I was for weeks saying, I think we're near the top, it should roll over, and it kept going higher. And they said, no, your melt up is happening now. And I said, no, I just, there's too many people on the bandwagon right now. So in February, I was talking about a 10% correction. And then we got the 10% correction from whatever it was, 3,300 down to the 3,000 or slightly under is what I was looking for. And I go, great, I look great. This is exactly what I called, and when, unbeknownst to me, that turned into a 30%, 35% correction. So I don't claim credit because I thought 10% was all we are going to get, or maybe maybe a
Right.
little more than that. So I get, people were picking on me for, well, you didn't see this coming, what,
Right.
all of a
Yeah.
sudden, the same people that were picking on me for, or giving me grief for calling for a correction that wasn't coming. Now we're giving me grief because I called for too small a correction. But in March of 2020, when we saw in 3 weeks the market go from that top down 35%, 3 weeks, it would have been easy for me to say, I guess we had our melt up. I guess we had our top. We're not going to get the real melt up I expected.
Right.
And now we're heading into the bust, because you know what it looked like then. It was really a bust.
Yep.
And it would have been easy for me to switch gears and say, I guess I was, a little premature or looking for a little more than we're getting, and this thing is rolling over sooner than I expected, and I got to switch gears and become bearish. I looked and I said, can that really be the case? And I looked at my work, and and there was just, the sentiment had turned so negative so fast, and stuff I said, and it had broken, from a technical standpoint, it had broken some important trend lines. So it would have been easy for me to go bearish. But I looked and I said, and this comes with, again, how much I put stock in sentiment. And I said, the sentiment is rock bottom. This is the kind of sentiment we see at bottoms, not tops. And I'm not talking about short term, I'm talking about important bottoms.
Mm-hmm.
So I said, no, it looks like all we're getting here, which the market likes to do, is it's a fake out, it's a fake breakdown. And so when almost the entire street was calling for lower, like into the teens on the S&P, I said, this is the bottom, 2,200. And I am sticking with my melt up target of something over 4,000 this year. So I expected we were going to go from 2,200 back up and see something over 4,000 maybe before the end of 2020. It obviously took longer, but I raised I think I had a $4,200 target on the S&P. I then raised that to 4,500. Then I raised it again. This is over the course of the last 18 months to 47 or 800. And right now I'm at, and then 5,000. Right now I'm at 5,300 on the S&P. So, and it's all been part of that same scenario that I started talking.
Sorry, I was just throwing up a chart so everybody could kind of follow along some of the prices that you're saying. It makes it a little easier.
Sure. Yeah. So from that 2,200 back in March, where you see the waterfall cascade down there, I expect that over the course of the next 6 to 12 months, we'd get up over 4,000 of maybe 4,200. As we progressed through, it became obvious to me, particularly with all the money that was being thrown into the system and all the fiscal expansion, that this thing had more legs than that. So I raised it to 4,500. And I didn't do it when we got there. I probably raised it to 4,500 before we got to 4,000. And then I raised it to 5,000 before we got to 4,300, I think. And people think, somehow I'm, that's wrong, that you shouldn't be changing your targets. And I said, I'm moving it as the evidence points to it.
Right.
I'm not going in the other direction. I'm going higher, and I'm doing it well before I reach my original target. So, and so I'm now at 5,300, and I think I'm probably going to end up raising it again. My expectation is we'll be in a melt up following this. I called this pullback. I got beat up in November because it wasn't coming. I said, you're going to have probably a 6% pullback in the S&P and maybe a little more in the NASDAQ. And then I expect a final leg up into a top. And I call this a 39-year secular bull market top. In other words, we started the bull market in August 1982. What I was talking about when I was at Textron,
Yep.
that was the beginning of this secular bull market. We've had cyclical bull markets through, many cycles here, but the full secular move started in August of 82, and I think will end in 2022.
Man, so then every time I like zoom out far enough, I look at anything, from 2009 plus, this just looks just very interesting to me, just an absolute bleed up. So something I'm
So,
curious. Oh, sorry, go ahead.
yeah, so what happens at the end of a big cycle, not a cycle like 2009 to now, but a big secular move, what happens is as you move towards the end of that, you go parabolic. So the
Oh,
slope gets steeper and steeper. And that the last leg of this bull market, if I'm correct, is going to be almost vertical. So you will cover, I think, a move from, let's say we're at around 4,500 now on the S&P. Let's say we move up to 5,500. I think you'll cover that ground. That's 1,000 points in somewhere between 3 and 6 months, and maybe, and I'm thinking it may be closer to 3 than 6.
what role do you think? This is a little bit of a sidestep. I want to come back to this conversation, but something I'm really curious about for folks like you. What role do you see retail traders playing in the overall market development? And I say that because, I've been reading a bunch of white papers that talks about, the advent of things like gamifying trading or gamifying stock buying, apps like Robinhood. And some folks are speculating that with the just significant influx of retail trader money as a whole, obviously a lot of retail traders as individuals don't really, count for much, but as an entire group, they start to matter, at least a little bit. Do you think that that affects your projections in terms of the market movement, or do you think that they're kind of just along for the ride and the market is still going to continue to move based off of just those bigger volume and bigger size trades, institutions, hedge funds, things like that?
Yeah, so my view is, as a contrarian, one of the reasons I'm a contrarian, probably a primary reason, is that at bottoms in markets, whether you're talking stocks or bonds or what have you, at bottoms, the vast majority of people are bearish, right?
Hmm.
At tops, the vast majority of people are bullish, are bulls. So I just view what's going on in the retail market with Robinhood and the MEMS, et cetera, the MEM stocks, et cetera. It's just a sign of how far along we are in the secular bull market. It just, it's more symptomatic of where we're at. For a long time, investors were skeptical and were bearish. So for much of the last 10 years, we've had pundits trying to call tops, saying we're at a top. And the retail public was, probably because of what happened in 2008-9 and a lot of things that have happened since, but they were skeptical and didn't want to commit money. So they had, money market funds have grown to huge amounts.
Hmm.
And a lot of people were in bonds and not in stocks, or were very, lightly invested in stocks. And in the last year, you've had that change where the retail public is coming into the market because it just became too obvious that they were missing something. So I view that as a more of a sign that we're getting near the top rather than, a driving element of the top.
That's a really, really interesting perspective on that. I literally hadn't thought about it that way, but that seriously makes a ton of sense because if there's enough of a draw for those folks, going off of your previous comments on the parabolic nature of things, especially it's so difficult to get with inflation where it is, at least right now, to get like a positive real rate of return. You pretty much have to into equities in some capacity because if you're doing anything else, you're bleeding maybe a little more slowly, but inflation is kind of killing you. So that's a really interesting way to look at that. Speaking of inflation, and I know that we're coming up on time, so I have a few more questions. If you have, if you have a few minutes, there's a couple others I had for you. Um, how do you view inflation right now and just the Fed's approach to managing it? So we talked a little earlier, about starting to hint towards maybe tightening policy a little bit, but just curious your thoughts on that.
Yeah, my view is we printed so much money, and there's a lag to when that money has an impact on inflation. So it,
Mhm.
and we print a lot of money in Q1, QE1, and QE2, and QE3. But this last thing since March 2020 is off the charts. I mean, we've
Right.
never, the Fed balance sheet in October of 2008 was 875 billion. Today we're at 8.5 trillion,
Yep.
and most of that 8.5 trillion, more than half of it, has occurred in the last 18 months. It went from 3.7 to 8.5
Right.
on its way on its way to 10. Um, so that money with a lag does create inflation, and I think that's what we're seeing. Is inflation is breaking out for the first time in 30 or 40 years, after ratcheting down from that early 1980s high and going from 20% inflation down to almost zero. We're now back up at talking about 6% numbers, and obviously, and my belief is that we're going to accelerate from here, that we're probably not done, even though the Fed's talking about taper and probably is going to taper. Inflation doesn't react to tightening quickly.
Mm.
You've kind of built in some momentum here, so I expect over the course of the next 6 months inflation to go higher, and that will keep the Fed saying, yeah, but then we got to do more. Um, so that's, I think, what's going to lead to Fed tightening, and what will lead to the end of this cycle, and what will lead to what I am calling a global bust. And I define a bust, as opposed to a recession, as something that's maybe almost as bad as a depression in some magnitude, but happens at the speed of a recession. So it's not
Mm.
drawn out like the Great Depression was over a decade. It's something where you'll have the damage of, we used the term Great Recession for 2008-9. I'd say the bust is something greater than the Great Recession, but not the length of a Great Depression. So
Right.
so in other words, we're looking at, in my opinion, the downturn here, when it comes, has the potential to be the worst in the post-World War II era and the worst since the Great Depression. So, something pretty bad, but happened relatively fast. And the reason I think we get there is we have 300, and I used to say 250, but we have $300 trillion in global debt. We went from 250 to 300 in just the last 18 months. So we
Right.
we have 300 trillion in global debt. We're adding trillions in the tens of numbers in a matter of a year. I mean, that's incredible stuff. Nobody can. If you asked anybody, nobody could really give you a hand and have a handle on what $1 trillion is.
Right.
And yet we're at 300 trillion in global debt. We're at quadrillions in terms of the notional value of derivatives. Those are both, debt and derivatives are both forms of leverage.
Right.
One's leverage on markets, one's leverage on the economy. But leverage works both ways. It enhances returns on the way up. It really destroys returns on the way down, and it exacerbates things. So my thing is that what would normally be a recession turns into something far worse, because of, we've never been here before. We've never had leverage like this, not even in 2008-9. We're not even close to those levels. We're way beyond those levels. And we've not had a downturn since 2008-9 to test what happens with this kind of leverage. So very simply, I think what might have been a normal recession turns into something far steeper and worse, but happens fast because leverage unwinds fast. And secondly, you've had a pandemic unlike anything we've seen in our lifetimes, And that pandemic, I mean, good God, we had a shutdown of the entire global economy for a quarter or more. Um, so what we have is an economy that's far more fragile because of the pandemic, coupled with an economy that's far more leveraged. When you combine that and then you tighten, you may find that it doesn't take much tightening to trigger a real big unwind. And that's my thesis anyway. That's my expectation. So I'm calling for a second half 2022 for the bust.
What
You know,
role what role do you think? So something I saw, I think the Financial Times put out a just fascinating chart to me, and it was like showing a declining graphic essentially of on market volume. So meaning that there's a lot of trade volume starting to happen off exchange, so via dark pools and things like that. I'm curious, do you think so? I guess I'll give you my hypothesis on that. I think that your expectations in terms of the decline, although based on probably a much broader amount of information than what I'm basing mine on, I have a similar conclusion to you in that there's likely a rapid unwind in the next 18 months. And one of the things I was thinking about that just made me feel like it was going to be something we hadn't seen before. It's just the amount of off exchange volume that is starting to be generated. Because I just feel like in those instances, whenever we've seen that happen before, when the unwind comes, it's typically just vicious because there is a ton of selling and then it starts going on market and off exchange almost simultaneously. I'm curious, do you have an opinion on just the movement of volume over time? Or do you think that the whole, like your whole projection is bigger than that concept?
yeah, I would look at it this way, which is that we've had since 2009 this onward and upward move, and so you've had people accumulating stocks, bonds, derivatives, what have you, all through the last what is it, 11 years. So, and then you have an event that has that unwind get concentrated in a very short period of time. So yeah, I can certainly see where, off market volume or off market activity has not been tested,
Right.
and so it all becomes basically part of the illiquidity that you see in a downdraft like that. And what gives when you have illiquidity is price. If everybody's on one side of the ship and they go to the other side of the ship, um, if everybody's moving as a crowd, it means you're not going to have much on the other side of that trade to hold it,
Right.
and then price just caves. So I think we're set up because of the length of this steady. Yeah, we had March of 2020, but it lasted, a month, 3 weeks.
Yep.
We've had some sell-offs. We had December of 2018, or a few months prior to that. But really, we've had this steadiness, steadily climbing higher and higher and higher, and then all of a sudden you have this, this one-time catch-up move. And I think we've seen it in flash crashes. This isn't a flash crash. This is a bear market. But over the course of several months, I can see an 80% bear market.
Interesting. That's
So that's
interesting.
peak to trough.
Yeah.
Now we haven't had a peak to trough market like that. I think we declined 60% in 2008-9 in the S&P.
Yep.
29 we had a 90% drop, 29 to 32. In 2000 the Nasdaq dropped, I think, 80 or 90%, but the whole market didn't. The S&P didn't drop nearly much at all compared to that.
Right.
This is going to be a global bear market where the whole globe is going to have big bear markets. And our 80%, when I say 80%, it's 80% in the S&P, 80% in the Nasdaq, 80% across the board. There's not going to take very many prisoners.
Right. It's I think your projection it's interesting to me because I have especially into 2022, I definitely was expecting a pullback, but a lot of the information you shared, even right now, has changed my thought on it a little bit, just in terms of the severity. Because as you start adding more detail that you're picking up on, that I hadn't necessarily considered, it like it does start to paint, a bigger picture. It's going to be interesting. Um,
The only thing I caution is I am calling for that melt up first.
right,
And and right now, it's not hard to sell people on the idea that we're going to have a bust, or it's not
right,
hard to sell people on the fact that we're going to have a big bear market. Particularly after this most recent sell off. Um, if we run up 1,000 points in the S&P, and it could be more than that, but something like that in the course of the next 3 to 6 months, that psychology is going to be totally shifted around. Where at the top, I can predict right now, at the top, people are going to call me crazy for talking about a bear market. They're going to say, "Oh no, this thing has legs. Don't you understand? You
right.
know, there's all this stuff going on that's good in the world and the economy, etc." So just know that it's easy when things are going south to see the negatives. It's going to be very hard to see them when because the market's not going to be up 1,000 points for no reason. It's going to have good news with it.
Right. So one more question. You've already shared a lot of your thoughts on 2022. So that was, one of the things I wanted to ask you. But if you were to bubble up maybe the top two or three things that you are looking for slash watching for 2022, what pieces of information, what, sentiments are most important to you looking into the next year?
I don't know. It really is watching how the investor evolves with the market. I mean, if how sentiment evolves with the market. As you get to the point where you have universal view of a bull market, the universal bullishness, that's when you want to start getting nervous.
Mm,
And everybody has to kind of choose their own point at which they want to anticipate this, because some people say, if we're going to drop 80%, I want to get out now because I can't sleep. What if I'm wrong? What if it happens sooner or whatever? So some people will not want to be part of that run up to the top. Other people will play it right to the edge, and some will go over the edge and miss it. So I mean, everybody's going to kind of figure that out, but ultimately the things I'm watching for a top will be, I mean, obviously the fundamentals will be part of it, but more importantly, it's the sentiment and the market movement itself. When I say vertical, I really think this has the potential to be quite stunning in terms of how much ground gets covered in a short time. And that becomes hard to resist.
yeah.
Think about a trade you made somewhere along the line where you were right, you got in, you were right on that trade, and then you said, but I don't want to be a pig. I'm not going to get slaughtered. I'm not going to get greedy. I'm taking it now. And you get out in the market, and that thing goes up another 10% the day after the next week after you sell it. You
I'm
say, I missed
smiling.
it. What did I do? Right?
I'm smiling because last year after the COVID drop, I was like, it's just a lot of bad news and things like that. And most bear markets are, like 250 days plus on average, something like that. And we had definitely, fallen into that. So I was like nibbling near the bottom, and then it just shot up. And I was like, what the hell just happened here? Like so that exact scenario happened to me last year.
Yeah, it's so easy to beat yourself up and say, well, why was I being so nimble? Why was I trying to be so careful or
Right.
whatever? But ultimately, um, you know, it's going to be up to people to figure out what their sleep at night quotient is, and to know there's a risk reward trade off here. You can try to get as close to the top as you want, but just know the risk is if you stay at the party too long, you can watch it all go away in a hurry. And I think that's going to be the signature of the bear market. Is I think this bear market I don't use the word crash because I think that implies things happen like in a matter of days. I'm
Right.
not calling for that. It's going to be a bear market over a matter of months, maybe, I don't know whether it'll be 4 months, 6 months, 8 months, 12 months, but it'll happen over a period of time, and it won't be a straight line. There'll be a bear market rally in there, et cetera. I'm pretty confident saying all that, but some of those steps down could be, you could lose 30% in a week.
Right.
And so those that say, I'm going to ride this, and they get caught up in the fundamentals or get caught up in the recommendations that'll be there at the top and then miss the top, may say, gee, why did I get greedy after the fact? So
Right.
you got to kind of, I can't give advice, and I don't have advice to give on that. It's really just kind of play it as it goes along. But everybody has to kind of make that. Just the biggest thing they have to do is understand that we're in a later stage of this, and that there is a pretty big downside that follows this.
So I told you I had that last question, and I apologize because I lied to you. I have one very last question. I promise this time. Um, so when you talk about sentiment and like monitoring sentiment, what are some of the ways you do that?
Well, probably the one seat of the pants one is on Twitter.
Hmm.
I know when I'm in pretty good shape, when I'm getting a lot of people calling me a tool or a fool. Um, so
No
that's
shortage
an
of
easy one.
criticism on the internet.
I can give you an example, because I've been calling for, I'm probably baseball on gold and silver on the market on the street, um, and it peaked out last August, August of 2020, came out of the March bottom and had a great run. I thought we'd have a few months of rest and then another big leg. Well, that few months has turned into 14 months, I think, 15 months. So people just want to say you're an idiot, and
Mm,
you're a broken record. You keep saying you're bullish and it's going the other way. But it's the asset out there that I love. And in terms of what it looks like, it's, in my opinion, the most undervalued asset on of all things out there right now. And there are setups that say this thing could go very, very strongly in the next several months. So, but it sold off in the last 2 weeks after having a nice run in October into early November. It's been basically selling off, and I saw that coming, but I didn't see it coming quite to this extent.
right.
And so now that it's just having the psychology effect on people that have been sitting in gold and silver, or the miners are feeling a lot of pain, and they just start getting angry. So that's one sign of sentiment, is when you see, as I have said, through 48 years, one thing that I feel I understand very well is sentiment. And I have made the comment over many years that investor psychology is the strongest emotion in the world. It's stronger than love or hate. That when something's going against you in a big way, financially, there's no bigger emotion on the emotional effect on people than that. So
Mm.
I don't take it personally when people start slamming me for, you're just wrong on gold and silver or whatever. It's very predictable psychology, and I understand it. I mean, it's at the point they're looking, it looks like it's never going to end.
Yeah, that's fair. I'm actually one of those people. I'm pretty bearish gold right now.
Okay.
But again, like with your context, I can see why. I think one of the biggest arguments I see that's like bearish gold with inflation where it is right now is one part of the equation, but then also people are starting to conceive cryptocurrencies as like a better substitute to gold. I'm not there yet myself. I still think cryptocurrencies are just way too volatile to serve the purpose that gold does. But yeah, in general, to me, it just seems like gold has been having a dog of a time getting its feet under it. But I'm actually excited. I'll be watching it pretty closely going forward. But I am not gonna lie, I have been fading the crap out of it. As soon as I see it make a rally, I'm hammering it. So,
Yeah, and my forecast for gold um, over the next 6 months is 2,500. My
really?
forecast my forecast for silver over the next 6 months is 50. So
That,
so obviously I'm not bearish.
yeah, I was gonna say I'm gonna just pull this up real quick so everybody can see. So this is 6 month daily on gold. So right now we're hanging like 1780-ish. So you're thinking 25 sometime next year?
Yep.
That'll be, and I mean, if that pairs nicely with, your expectation of the drawdown, that definitely seems within the realm
Yeah,
of
actually not.
possibility.
Actually not. This is prior to the bust.
Oh, interesting.
Yeah, so I expect it to come down with the rest of the asset structure in the bust in the bear market.
Hmm.
So I think it'll hold up much better than equities. So equities
Right.
dropped, let's say 80%. Gold might come back from 2,500 back to 1,800. Um, silver might go from 50 back to 30. So pretty good drop, but not all the way back. And
Right.
then following the bust, because what will have to happen in the bust, and I call this the most predictable part of my forecast, or the easiest part to predict. We will see the Fed's balance sheet grow from 8.5 trillion now. I wouldn't be surprised if it's certainly 20 trillion, maybe 30 trillion in response to the bust.
Oh, got it. Yeah.
So if you have that kind of money, that's many times what we saw in the last 18 months, last 20 months. If you have that kind of money, it's going to jumpstart an inflation cycle. I fully expect us to retrace fully the last 40 years of inflation, disinflation slash deflation.
Hmm.
So if we're in the bust, you could see a little bit of deflation. You could go from this inflation problem now and actually see a small bit of deflation, short deflation. From there, let's say from 2023 to 2030, I expect we'll go from zero negative to 20% plus
Mm. That
in eight
that
in 8 years,
that will
and that
be
that will
interesting.
get silver and gold going.
Yeah.
So I fully expect gold to be 10,000 plus, could be 20,000 by the end of the decade. I fully expect silver to be $400.
Man, that's awesome. I love the way that, I don't know, you think about the movement of those things, because for me, again, like my trading window, like I don't think it's insignificant, but it is insignificant compared to you. And even when people talk about inflation now, we're complaining about 6%. You know what I mean? And you've already seen 20. You know what I mean? So it's just,
Yeah, I'm
I
saying this is a mini inflation cycle,
yeah,
and because of what's going to happen with the bust, it's not a straight line. That's what I talk about that with commodities. I go, the
right.
next cycle is going to be all commodities, and so yes, we've broken out here, but you've got a bust between this commodity run here and the big commodity run that will follow the bust, because I'm predicting $400 oil
Mm,
out the end of the decade. So, but before we get there in the bust, I think oil can go back into the 20s. So you will go from 20 to 400 or 25 to 400 in 7 or 8 years. As I say to people who talk about a commodity super cycle, just be careful. It's like standing on the south rim of the Grand Canyon, looking across to the north rim, and thinking you can walk straight across.
mm,
You've got that canyon in between, in this case, a bust. That means, yes, you'll have a big commodity cycle, but it's not straight from here.
right, right. Man, that's a super fun part of the conversation. I literally could just keep going on that. So I did promise after I lied to you the first time that the last one was actually the last question. So I will shut up here. But I like I said, I love these sessions so much, especially with folks like you that have experienced what you've experienced, and you take the time to share it, with people like me and my audience. Um, Literally cannot thank you enough for taking the time to connect with us. So first, from that perspective, thank you, personally, very much.
Sure.
It's really interesting hearing about your experience. I love just learning about your background, what you've seen before. Definitely have a laundry list of more questions, but I'll have to, bug you some future time to see if I can get you back on. But um, out of curiosity, would love to hear, how people can find you. I know that you're on Twitter. That's where I found you. I follow you on there. But what's your Twitter handle, and what other ways can people reach out to you?
Sure. Yeah, I'm on Twitter most every day. So you can reach me there at Dave H. Contrarian. And be careful. There's some phony accounts out there that change the spelling of contrarian, and so there's a lot of kind of dummy accounts out there that try to pretend they're me. They'll
Mm.
have they'll have my profile picture and stuff. So make sure it's Dave H. Contrarian spelled correctly.
Well,
Um,
what I could do for that is I'll just, in the video description, I'll throw the link to it so that they can go right
Great,
to it.
great. Yeah, that'd be great. And then I do write a quarterly letter, macro letter. So if anybody that's by subscription, there's an annual fee to it. So if anybody's interested, they can direct message me on Twitter, and I'll get right back to them.
Awesome. Well, like I said, thank you so much. I like sincerely enjoyed this a ton, and I would love, to do another session with you in the future.
Sure. Yeah, we'll come back maybe in 6 months and see how wrong I was.
Well, it's like I tell my audience all the time, if you want to make a bunch of money, just do the opposite of what I do, and then you'll be all right.
Exactly.
Awesome. Thank you.
Okay. Thanks, Eric.